the Cassandra of finance, the life, philosophy, and prophetic vision of Michael Burry. Good morning and welcome. In our journey through the halls of financial genius, we have encountered charismatic leaders, systematic architects, and aggressive activists. Today, we turn our attention to a different archetype altogether, the isolated prophet, the obsessive misfit, the individual whose unique perception of reality allows them to see a truth that is invisible to the entire world. He is not a leader of men or a master of corporate persuasion. He is a lone wolf, a forensic analyst of the highest order, whose greatest strength, and perhaps his greatest burden, is his ability to stand completely alone against the roaring tide of consensus. He is the living embodiment of the quote from the philosopher Schopenhauer: "All truth passes through three stages. First, it is ridiculed. Second, it is violently opposed. Third, it is accepted as self-evident." His name is Dr. Michael Burry. He is the man who, against all odds and in the face of universal scorn, foresaw the collapse of the subprime mortgage market with a clarity that bordered on the supernatural, and in doing so, engineered one of the most famous and profitable trades in the history of finance. His story, popularized in the book and film The Big Short, is often told as a thrilling underdog tale. But to leave it at that is to miss the deeper, more profound lessons about the nature of markets, the psychology of crowds, and the immense personal cost of being right when the world is wrong. His career offers a masterclass in independent thinking, the courage of conviction, and the psychological fortitude required to act on a deeply unpopular truth. It is a story about the tension between genius and consensus, and the heavy price of clarity. Part 1. The education of an outsider. From medicine to the market. To understand Michael Burry, one must first understand that his mind does not work like that of a typical Wall Street investor. He was born in 1971 and grew up in San Jose, California. From a young age, he was different. He lost his left eye to a rare form of cancer, retinoblastoma, at the age of 2, which left him with a glass eye and instilled a lifelong sense of being an observer, of watching the world from a slightly detached analytical perspective. This physical difference was not just a detail, it was formative. It meant he could never fully blend in. It forced him to develop an inner world, a fortress of the mind, where logic and data reigned supreme over social cues and popular opinion. He became a voracious and autodidactic reader, consuming books on history, economics, and, crucially, value investing with a ferocious, uncompromising intensity. He wasn't reading for entertainment, he was building a mental operating system. He was not groomed for a career in finance. In fact, he consciously pursued a path of rigorous science and discipline, attending Vanderbilt University for his undergraduate degree and then the University of Virginia School of Medicine, followed by a prestigious residency in neurology at Stanford University. He was, by all accounts, a brilliant and dedicated medical student. The field of neurology, the study of the brain's intricate wiring, suited his analytical diagnostic mind. But his intellectual passion was constantly pulled in another direction. In the quiet, exhausted hours of the night, while his colleagues slept, he was obsessively studying the stock market. He started a finance blog, which he called Value Investing, and began publishing his detailed, meticulously researched stock analyses. His writing was not flashy or designed to attract a crowd. It was dense, data-driven, and profoundly insightful. He practiced what he called deep value investing, a philosophy rooted in the teachings of Benjamin Graham and David Dodd, searching for companies that were so statistically cheap, so utterly hated by the market, that they were trading for a fraction of their net current assets, the cash, inventory, and receivables on their balance sheets, minus all liabilities. His blog began to attract a significant and discerning following. His analytical prowess was undeniable. He was making hypothetical investment returns based on his picks that were so spectacular they defied belief. And he was doing it all while working 100-hour weeks as a medical resident. The cognitive dissonance became unbearable. Here he was, on a prestigious, secure, and respected path to becoming a Stanford neurologist. Yet his true intellectual passion and demonstrable genius lay in the world of finance. He faced a critical choice: continue in a profession he respected but did not love, or leap into the unknown world of managing money, where he had no pedigree, no network, and only his own intellect as capital. In a move that shocked his family and colleagues, he walked away from his medical career just a few years before completing his residency. He took his entire life savings and a small, trusting amount of seed capital from his family. And in the year 2000, he founded his own hedge fund, Scion Capital, named after the fertile shoot of a plant. He was betting on himself in the most profound, all-or-nothing way possible. Part 2, the Scion Capital Phenomenon, a deep value prodigy. The early years of Scion Capital were a stunning validation of Burry's unique talent and his unorthodox path. He was not a macro trader or a market timer. He was a pure stock picker, a classic value investor operating in the most extreme, neglected corners of the market. His strategy was simple in concept, but excruciatingly difficult in execution. He looked for what he called cigar butts, companies that were so beaten down, so despised, that they had one last puff of value left in them. He would buy these stocks at a massive discount to their tangible worth, often when they were in bankruptcy or facing scandal, and then wait, with immense, almost superhuman patience, for the market to recognize its error. His process was one of almost monastic focus and self-imposed isolation. He worked from a small, windowless office in San Jose, communicating with the outside world primarily through email and lengthy written correspondence. He did not take meetings with Wall Street analysts or corporate management. He did not watch financial television or follow the daily news cycle. He believed these were sources of noise, not signal. Instead, he read. He analyzed thousands of pages of financial statements, annual reports, 10-Ks, and corporate filings. He was looking for the gap, the chasm between the market's emotional, often hysterical perception of a company and its underlying cold financial reality. His investment letters to his investors were legendary, lengthy, educational, intellectually dense treatises that explained his investments in granular, uncompromising detail. He was not just managing their money, he was trying to teach them how to think, to see the world through his lens of logic and margin of safety. The results were staggering and silenced any initial doubts about the doctor-turned-investor. While the dot-com bubble was bursting and the S&P 500 was falling dramatically in the early 2000s, Scion Capital was soaring. In its first full year, the fund was up 55%. From its inception in November 2000 through the end of 2004, the fund had returned an astonishing 242% after fees, massively outperforming the plummeting market. Investors, recognizing true genius, flocked to him. He had proven that his unorthodox, isolated, and intensely focused approach could generate extraordinary returns. He was a rising star in the value investing world, a modern-day Benjamin Graham operating out of a California strip mall. But this initial success, as remarkable as it was merely the prelude. It was the proof of concept for a mind that was about to be turned on a far larger, more dangerous, and more complex problem. Part 3, The Big Short, a forensic unraveling of a national delusion. By 2004 and 2005, Burry began to feel a deep, nagging unease. His deep value stock picks were becoming harder to find. The entire market seemed elevated, pumped up by easy money and rampant speculation. He felt a sense of foreboding he couldn't ignore. So, true to his nature, he went looking for the source of his disquiet. He began to look not at individual stocks, but at the entire economic ecosystem. And his diagnostic gaze settled on the beating heart of the American dream, the U.S. housing market. What he saw, upon closer inspection, alarmed him profoundly. He noticed that home prices had been rising at an unsustainable, parabolic rate for years, far outpacing household income growth. But his true earth-shattering insight came not from observing the housing market itself, but from diving into the complex, opaque, and deliberately confusing world of mortgage-backed securities, MBS, and their even more esoteric and dangerous cousins, collateralized debt obligations, or CDOs. While the rest of Wall Street, the traders, the bankers, the rating agencies, saw these instruments as safe, diversified, AAA-rated pieces of financial engineering, Burry saw something else entirely. He spent months, late into the night, reading not the summary reports, but the very prospectuses and data tapes for thousands of individual mortgages that were bundled into these securities. He was not looking at the comforting letter grades from Moody's or S&P. He was looking at the raw, unvarnished data, The FICO scores, the loan-to-value ratios, the documentation types. What he discovered was a systemic rot, a fraud hiding in plain sight. He saw that a massive and growing proportion of these mortgages were subprime, meaning they were made to borrowers with poor credit histories, often with no documentation of income, liar loans, and frequently with no down payment. Even more dangerously, he identified the pervasive prevalence of adjustable rate mortgages, or ARMs, with teaser rates that would reset to much higher, unaffordable levels in 2 or 3 years. He built complex, painstaking financial models that projected what would happen when these mortgages reset en masse, synchronized like a time bomb. His conclusion was terrifyingly simple and mathematically inevitable. There would be a tsunami of defaults. The entire towering edifice of mortgage-backed securities, which was built on the foundational assumption that home prices would only ever go up and that defaults would be uncorrelated, was a house of cards. The AAA-rated tranches of CDOs were, in his clinical opinion, not just risky, but ultimately worthless. He had identified the greatest financial bubble in modern history, and he decided to bet against it. The monumental problem was, there was no easy, straightforward way to short the housing market. You couldn't short a house. So, in a stroke of creative financial engineering, he invented a way. He turned to the relatively new and niche world of credit default swaps, or CDS. A credit default swap is essentially an insurance policy on a bond or a basket of bonds. Burry decided he would buy CDS protection on the specific mortgage bonds he was certain would fail. He would be paying a small, ongoing insurance premium, like paying the premium on a life insurance policy. If the bonds remained healthy, he would slowly bleed money, month after month. But if they defaulted, the payout would be enormous, akin to paying a tiny premium on a life insurance policy for a terminally ill patient and then collecting the multi-million-dollar payout upon their death. It was the definition of an asymmetrical bet: limited, defined downside, and virtually unlimited upside. He began calling the major investment banks, Goldman Sachs, Deutsche Bank, Morgan Stanley, and others, and asking to buy credit default swaps on specific toxic mortgage bonds. At first, the bankers on the other end of the line were confused, then amused. They were happy to take his money. They saw him as an eccentric fool, a perma-bear, who didn't understand the new, modern, and perpetually rising U.S. housing market. They sold him billions of dollars worth of insurance, pocketing the premiums and laughing at the doctor from California. For 2 agonizingly long years, from 2005 through 2007, Burry sat in his office and watched as he lost money, month after month, quarter after quarter, paying his insurance premiums as the housing market, against all logic and his own models, continued to creep higher. The psychological pressure was immense, a relentless test of will. Part 4. The Agony and the Aftermath. The Cost of Being Right. This period was the crucible of Michael Burry's life and character. The trade was not just a financial position on a screen. It was a test of his entire worldview, his intelligence, and his sanity. His investors, who had once revered him for his stock-picking genius, grew restless and then openly hostile. They could not understand why he was wasting their money and their profits on these bizarre, bleeding insurance policies that showed consistent mark-to-market losses. They sent him angry, demanding letters and emails. They berated him on conference calls. They demanded he unwind the trades, calling them a reckless diversion. Several large investors threatened to sue him. The Wall Street banks who had sold him the swaps also began to get nervous. They saw the size and specificity of his positions and realized with dawning horror that if this lone wolf was right, their trading desks faced catastrophic, firm-threatening losses. They started to push back, employing tricky legal language, demanding more collateral, and using bureaucratic obfuscation to try and avoid their obligations, sensing the monster they had created. Burry was now completely isolated, trapped in a nightmare of his own prescience. He was a modern Cassandra, a man standing on the beach, pointing at the horizon at a tiny, almost imperceptible dark line, screaming that a 100-foot tsunami was coming, while everyone else enjoyed the sunny, calm day and called him a madman, a loser, a gambler. The emotional and psychological toll was devastating. He was plagued not by self-doubt in his analysis. The data was clear, but by the terrifying possibility of his timing being wrong. The famous line from John Maynard Keynes haunted his every waking moment. The market can stay irrational longer than you can stay solvent. He was risking the total destruction of his fund, his hard-won reputation, and his investors' capital. The stress manifested physically and mentally. He was, in his own words, having panic attacks and not sleeping, shouldering the unbearable weight of being right too early. Then, in the spring and summer of 2007, the first cracks appeared in the dam. Bear Stearns announced the collapse of two of its hedge funds that were heavily invested in subprime mortgage securities. The tide of sentiment began to turn from complacency to fear. By late 2007 and into the catastrophic year of 2008, the wave of defaults that Burry had predicted with such precision hit with full, devastating force. The housing market collapsed. Major financial institutions like Lehman Brothers failed. The mortgage-backed securities he had insured became worthless, tranches of garbage, as he called them. The payout triggers on his credit default swaps were activated. The result was one of the most asymmetric, legendary payouts in financial history. While the global financial system teetered on the brink of collapse, Scion Capital delivered a net return of 489% for its investors in 2007 and 2008, after accounting for losses in other parts of the portfolio. From his prescient bet, Burry had personally netted a profit of over $100 million for himself and approximately $700 million for his remaining steadfast investors. He had been right. Prophetically, catastrophically, undeniably right. But the victory was Pyrrhic, hollowed out by the journey. The constant bitter battles with his own investors, the immense unrelenting stress, and the profound disillusionment with a financial system and a society that had been so blindly, greedily, and irrationally wrong, left him deeply scarred and cynical. In 2008, exhausted and disgusted, he closed his fund to outside investors, returned their capital, and shut down Scion Capital. The man who had seen the crash coming with crystal clarity could not bear to continue operating within the very system whose fatal flaws he had diagnosed. The prophet wanted to leave the temple. Part 5, The Enduring Lessons of a Reluctant Prophet. The story of Michael Burry is not just a thrilling financial drama. It is a source of profound and timeless lessons for any investor, entrepreneur, or individual seeking to think independently in a world of overwhelming social pressure and narrative-driven consensus. 1. The supreme power of first principles thinking. Burry did not outsource his analysis to Wall Street research, credit rating agencies, or economic pundits. He went back to the raw primary source data, the individual mortgage documents, and built his own understanding of reality from the ground up, brick by brick. He trusted the output of his own rigorous bottom-up process over the soothing, consensus opinions of every supposed expert. This teaches us the critical, non-negotiable importance of doing our own work, of building our own models of reality from primary sources, rather than blindly accepting the second-hand, often conflicted analysis of the crowd. 2. Intellectual courage is the rarest and most valuable asset. It is one thing to have a non-consensus view, to quietly believe something different. It is another thing entirely to bet your career, your reputation, your personal wealth, and the capital of those who trust you on that view. Burry's story is a masterclass in the raw courage of conviction. He withstood universal ridicule, professional ostracism, the fury of his clients, and the specter of total financial ruin for years, solely because he trusted the unemotional verdict of his data. His courage was not the absence of fear, but the action taken in spite of it. 3. The market is a voting machine in the short run, but a weighing machine in the long run. This famous Ben Graham quote was lived and breathed by Michael Burry. For 2 long years, the market voted overwhelmingly that he was wrong, stupid, and reckless. His trade showed persistent losses, but eventually, inevitably, the fundamental economic reality, the actual weight of the bad debts, the unsustainable math, overwhelmed the popular vote. His story is the ultimate testament to the importance of a long-term perspective anchored in fundamentals, and the utter futility of trying to win a short-term popularity contest with a manic, often delusional market. 4. True, actionable insight often comes from the fringes. Burry was successful precisely because he was an outsider in every sense. He was not a product of the Wall Street fraternity or its pervasive groupthink. His medical training gave him a diagnostic, scientific, and probabilistic mindset. He looked for symptoms, diagnosed the disease, and assessed the prognosis. His physical difference fostered a psychological detachment. This is a vital reminder. The most valuable and disruptive insights often come from those who are not embedded in the dominant culture, who are free to question its core assumptions precisely because they have not been rewarded for accepting them. 5. Being profoundly right can be a lonely and unrewarding experience. The Hollywood ending of The Big Short obscures the profound personal cost Burry paid. The psychological torment, the broken relationships with his investors, the deep, enduring cynicism, and the emotional exhaustion he experienced are the hidden, non-monetary price of his prophecy. It serves as a sobering, necessary reminder that swimming relentlessly against the tide is exhausting, lonely, and can extract a heavy toll on one's mental well-being and personal relationships, even in the moment of ultimate victory. The crowd hates a prophet who disrupts its comfort. In the years since, Michael Burry has continued to trade for his own personal account, often making provocative, contrarian, and cryptic bets on everything from water rights to private prison stocks. He remains a vocal, if deliberately obscure, commentator on markets, frequently warning of new bubbles and systemic risks in his sparse, enigmatic tweets. He is, and likely always will be, a modern-day Cassandra, a figure from mythology who was cursed to see the future with perfect clarity but was doomed never to be believed until disaster struck. His legacy, therefore, is not merely the billions of dollars in profits he generated, but the powerful, enduring, and unsettling lesson he embodies, that the greatest investment one can ever make is in the unshakable integrity of one's own reasoned judgment, and that this requires a willingness to stand utterly, painfully alone against the world, bearing the weight of truth long before others are ready to see it. Thank you.